Welcome back to Alpha Recap. I'm really glad you're with us. Quick note before we dive in. If you have questions about anything we cover, you can reach us at stockalpha.ai and ask us directly. Today, we've got a packed conversation about a big headline that moved markets, some interesting strategist takeaways, and a slew of regulatory filings that traders should not ignore.
Great to be here. Thanks for the invite.
What really stands out here is that the day opened with a headline about roughly $16 billion tied to 5 mega-cap names. That was Nvidia, Apple, Alphabet, Amazon, and Microsoft. And the story said people close to companies representing more than $2 trillion signaled concerns. How did that land from a fixed income or market structure perspective?
Right. So first, and this is key, the headline reframed concentration risk. When reporters put those 5 companies together in a warning, it isn't just about the companies themselves. Funds that track market cap-weighted indexes feel outsized moves. The noise around those names can trigger ETF rebalancing, derivative hedges, and, frankly, some forced flows.
I mean, when you step back and look at this, that kind of headline can compress confidence pretty quickly.
Exactly. And in fixed income, even though we don't trade those stocks directly, portfolio managers watch correlation and liquidity. If everyone expects a big move in a handful of megacaps, correlations spike, and even otherwise uncorrelated assets can tug on broader indexes.
The really interesting wrinkle today was Goldman Sachs pushing a nearly opposite narrative, arguing that parts of tech are trading at a forward price to earnings near 18 times, which they framed as selective entry points for long-term buyers. How do you reconcile that with the $16 billion warning?
There are 2 overlapping threads. One is headline risk, short-term, market mechanics-driven repricing. The other is valuation-driven opportunity. Goldman's point is, some segments look cheaper on a forward basis, but that doesn't automatically mean it's time to load up. Time horizon, liquidity needs, and company fundamentals matter.
So lower multiples could mean a buying window or a warning sign. Got it. Honestly, I was a bit surprised by this one.
Yeah, that tracks. Lower multiples can be a signal of durable risk, slower revenue growth, margin pressure, or regulatory drag. Or they can be a transitory dislocation caused by short-term fear. That ambiguity is why Goldman used the word selective.
Let's break that down in plain English for listeners. What does selectivity actually mean in practice?
It means looking through the headline noise and assessing company-level fundamentals, revenue trends, profitability, product cycles, and exposure to regulation. If a company has improving cash flow and resilient demand, a lower multiple may look attractive for a long horizon. But if earnings are at risk, the multiple could compress further.
Right. So funds and investors have to choose between broad safety and micro-level due diligence. Short reaction, big tension.
Big tension, exactly.
Another thread today was a wave of Form 8K filings. Everything from ETF issuers to small biotech companies and even an insurer like MetLife. What should traders and risk managers be looking for in those filings?
Form 8Ks are essentially corporate speed versions of news. They disclose material events, agreements, and governance matters. The filings we saw today included items tied to ETF operations, material definitive agreements, and selective disclosure flags under Regulation FD. Traders should read exhibits closely, because they often preface market-moving announcements.
Give me an example in plain terms.
Take an ETF filing that mentions staking mechanics or custody arrangements for an Ethereum staking product. That can change investor expectations for yield and liquidity, which in turn alters flows into or out of the ETF and into underlying crypto markets.
So crypto ETF filings could change real flows in the market. Got it.
Yes. And for corporate filings, like the ones from biotech or SPACs, you might see items that signal upcoming votes, financings, or agreements, all potential catalysts for big moves in small cap names.
Quick reactions. Read the exhibits, watch for governance items, and pay attention to any Regulation FD flags.
Exactly. Regulation FD notes suggest potential selective disclosures, something risk teams should watch carefully.
Let's switch to how different investor types might act after a day like today. Passive investors first. What's the takeaway?
Passive funds should monitor concentration risk. When a handful of names dominate index returns, single stock stress can cascade across passive strategies. Analysts note that passive investors have limited control over individual weightings, so understanding tracking risk and any overlays matters.
Active long-term investors?
Focus on company fundamentals and selectivity. Where earnings and cash flow trajectories look solid, lower multiples can provide tactical entry points. But do the homework. Revenue mix, margins, product cycles.
Event-driven and activist players?
Watch those 8Ks closely. They're the primary sources for upcoming catalysts: shareholder votes, material agreements, and regulatory disclosures. Those can create actionable windows for short-term strategies.
Crypto and ETF-focused investors. A sentence on that.
Grayscale's filings on an Ethereum staking ETF and a mini ETF are worth watching. Staking mechanics, custody language, and yield disclosures can materially affect flows and underlying liquidity.
Risk managers and quants.
Reassess factor exposures and derivative positions. Headline concentration around the same megacaps calls for stress tests that model correlated shocks and options-driven hedging behavior.
Let's do a quick tactical checklist for listeners. Concrete things to monitor in the coming days.
Read the exhibits in today's Form 8Ks for Haymaker, Grayscale, and the others. Monitor volatility and options flow around the 5 megacaps. Look for volume spikes and changes in put-call skew. Track strategist notes, including follow-ups from Goldman, for screens where forward price-to-earnings compression aligns with improving fundamentals. And watch ETF flows and staking disclosures for crypto products.
Short reactions. Read the filings. Watch options flow. Monitor ETF flows.
Yep, short and sweet.
One more practical question. If someone hears $16 billion in a headline, are they meant to be alarmed or to dig deeper?
Dig deeper. Headlines are a trigger, not a verdict. The figure is powerful because it reframes concentration risk, but the underlying drivers, whether hedging, funding, or idiosyncratic issues, matter a lot. Context is everything.
Final bit. Agreed and disagreed views among analysts. Where does consensus lie, and where are opinions split?
Consensus. Tech and megacap names are the focal point for both risk and opportunity. Also, event-driven volatility is elevated because of those filings. Disagreement centers on direction for megacaps. Some see the $16 billion headline as reason for caution. Others see lower multiples as selective buying windows. The interpretation of compressed multiples is also up for debate.
Right. So the practical takeaway is layered. Reassess concentration. Prioritize company-level fundamentals and keep an eye on those 8Ks for idiosyncratic catalysts.
Yep. And risk teams should stress test for correlated shocks among the big names, while event-driven traders should dig into exhibits for immediate catalysts.
All right, time for the quick takeaways so folks can walk away with the essentials.
First, a headline about $16 billion tied to 5 megacaps reframed concentration risk and amplified index mechanics. Second, Goldman's note that parts of tech trade at around 18 times forward earnings highlights selective opportunities, but valuation alone doesn't solve timing or company-specific risk. Third, today's wave of Form 8K filings is a reminder that micro-corporate events and regulatory disclosures can be as market-moving as macro headlines.
Quick filler. So, in short, read the filings, mind the concentration, and be selective.
Exactly.
A brief note on disclosure. This discussion is informational and analytical. It is not a recommendation to buy, sell, or hold any security, and it is not personalized investment advice. Analysts note the signals and data. Listeners should do their own due diligence and consult their advisors. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks so much for joining us. And Kate, thank you for making the fixed income world understandable and interesting.
My pleasure. Thanks for having me.
All right, folks. That's Alpha Recap for today. We'll see you next time. And remember, if anything puzzled you, stockalpha.ai is where to go. Bye for now.